So I just picked out a few things from Jerome Powell's statement, which actually his initial statement when it was released, the market jumped up quite a bit. It was a red day. It sort of came back to level. And then it seems to be most of the time when Jay Powell actually reads his speeches out, the market collapsed quite quickly. But there's a few things out there that I've picked out that he said that were quite interesting. So in the press release, it said, in determining the pace of future rate increases, the FOMC will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and financial developments. So that was really him there, giving a kind of dovish kind of statement out to the market. The market really liked that because that was the famous Fed pivot that people have been waiting for, when the Fed stops tightening monetary policy and allows it to maybe lapse a little bit, and at least they know where the top of the interest rates are going to be. So in his actual speech, though, he said, the incoming data since our last meeting suggests the terminal rate of Fed funds will be higher than we previously expected, which, for the record, was 4.63%, and we will stay the course until the job is done. They were actually repricing in about 5.08% now, so that's a whole, 0.5% over what the market had been expecting. So he said, what's far more important now is for how long rates will remain high, and we will stay the course until the job is done. So the market is probably now thinking you're going to have, core interest rates at 5%, but also at 5% for a longer period than they thought it was going to be. And just to finish his last bit, he signed off with, risk management is key here. If we were to over-tighten, we could use our tools to support the economy later on. But if we failed to tighten enough, inflation would become entrenched, and that would become a bigger problem. So he's basically saying here he's going to crank that dial up to as much as he needs to, and he'll ease off if it becomes a massive monetary problem, if there's a problem in the monetary system. So anybody who thought there was a Fed pivot coming, I'm afraid, despite him sort of hinting at it in his initial statement, he's not pivoting at all at the moment. But Steve, do you want to quickly chime in with the rate increases? What actually happened on the day?
Sure. So the US Federal Funds Reserve rate has now reached 4%, I think, which surprised pretty much nobody. We've had an interest rate decision in the UK as well since then. That happened today, as we record today. Interest rates have now reached 3%, which is the highest they've been since 2008. I heard the Bank of England guiding for 11% inflation in Q4. So I expect that to go higher, I think, in all kind of likelihood. Just as a quick comment on this before we kind of get into some other more detailed stuff on this and our views, I suppose, it's earnings season at the moment, and I couldn't help but feel like both of these things felt like a kind of earnings call to me, where there was sort of the bit where everyone's trying to guess at a number, which is sort of like an earnings number, but in this case is an interest rates number. That surprised nobody from what I can see in either case. Pretty much both those numbers went where they were expected to go. And then there's the bit where they kind of give you the sort of guidance going forward. And in both cases, the guidance was sort of fairly disappointing, and the markets reacted to potentially that sort of guidance effectively. What you're hoping for guidance-wise, positive news for stocks is that we're going to either slow down or stop, or things are looking all right, or we're at least going to not keep raising things at the rate we were at. Negative news is we basically are, and it seems like every time there's been one of these earnings call interest rate things, investors have all been saying maybe this time, maybe this time, maybe this time. From what I can see, mostly out of hope over expectation, because inflation just keeps going. Well, it started to inch down, but I mean by decimal points in the US. And in the UK, it's gone up to 10.1% and guiding for 11. So I get that inflation is coming out in other areas like commodity prices and so on, but with the CPI or whatever metric they're using at those kind of numbers, I just can't see it, and I refuse to be surprised by rates continuing to go up here. Paul?
Right, where to start? I didn't realise that. I fully thought that there was just going to be another 0.75% basis point raise, and I'll explain why I thought that at first, but I didn't realize that on FinTwit and YouTube and all that, there was this undercurrent of people drumming up this support for the famous Fed pivot, and people were believing it. So as far as the markets go, I don't think we're at capitulation yet, because I think there are still people listening to idiots on the internet and taking binary bets. So that's my first bit there. But my reasoning behind why I think that the Bank of England are going to keep raising and the Fed are going to keep raising as well is because there is you can do a risk benefit analysis on this, and there is there is less risk on the overly harsh side of this than there is being more dovish, basically. So it's, if you are too hawkish in this situation, you are going to maybe slightly or overly drive down employment rates and things like that, and you are going to crash the stock market a little bit more than it already is. But if you're too dovish, you've got inflation going out of control and people being completely unable to live. And so the central banks are, in this situation, are going to go too far. They're always going to go too far. And then they're going to get confirmation that they've gone too far. And then they're going to start to pull it back a little bit. That is the only way, due to risk. And all he's doing, all Jerome Powell and people who are advising him are doing, are they're simply running a risk-based analysis and deciding that going too far is the less risky or is going to do the less damage. And that's where we're at.
Yeah, one of the interesting points that CNN pulled out was that the Congressional Budget Office have now reckoned that by 2029, the government will be spending more, the US government will be spending more on interest than it does on its defense budget, which is kind of amazing for America, because they really do love their defense budget. But that's made everybody a little bit nervous. This is probably why you're seeing the sort of reactions you've seen today, over the last couple of days in pricing. Everybody's just repricing in this additional risk here. I guess as well, the Fed, when they start quantitative tightening, you're going to lose a buyer in the market, which is obviously always going to have a negative effect, especially one with pockets as deep as the Fed and the Treasury have. So yeah, it's definitely interesting. I mean, I wasn't thinking there would be a pivot. I think a little bit deep down in your sort of like your heart, you think, oh, maybe if there is a pivot, I can get myself out of this sort of red rut that I've been in for the last, what feels like 18 months. But I think I've heard you say a few times, Steve, it's not the right time for the Fed to be pivoting. They need to sort out the economy. And unfortunately, what happens off the back of that, and which is usually pretty horrible for people tend to lose their jobs, lose their houses, default on things that they could otherwise afford. That all, unfortunately, needs to happen to right this sort of wrong that's happening at the moment in America, which is sadly nearly 14 years of quantitative easing, which was really, really ramped up in the last couple of years.
Yeah, so to Paul's point, the risk on the kind of downside here is basically a recession, and if you raise too far and too fast, you will get a worse recession, effectively. There's a couple of things, I guess, connected to this, though. One is I always like to find something to disagree with that I've heard about in the last week or so, just so people don't get the idea that I'm some awful yes man who has no views on something. But I heard someone saying that people complaining about the Fed raising interest rates too quickly is kind of ironic, because it's the same bunch of people who complained they were raising them too slowly before, or they were being too dovish during the kind of inflation period. And he was suggesting that, look, if you thought they were raising them too slow earlier, you should be pleased about them raising them quickly now, and trying to catch up. That does not follow, for what it's worth. It does not follow from the fact that you were doing something too slowly that you should now do it as fast as you possibly can. If Steve's given me a lift to work through the streets of Hull or something like that, and I complain that he's been driving along at 5 miles an hour, that doesn't mean I want him to drive at 90 for the rest of the damn thing. That means I want him to drive at the appropriate rate for the entire time. It's possible to be too slow and then too fast, one way or another. So I take the point about kind of concerns about doing these things too quickly and too slowly, but I don't think that the fact that some people were complaining this is too slow in some way kind of defeats their right to say this is too fast. That to me doesn't seem to make much sense. I get that it's a kind of risk analysis thing, and I get where the Fed is trying to go with this kind of thing. So in terms of what this means for stocks, I'm trying to keep calm and carry on a little bit.
They're going to keep doing this until they see inflation right back down. This is going to continue, and we need to be prepared for this. You need to batten down your hatches, you need to save a lot of money, and you need to stick to the plan, whatever your plan may be, because this is going to keep going. And it's going to be rough, isn't it? Next year, the recession is likely to be coming, as far as Stanley Druckenmiller thinks. We aren't showing signs of that just yet. And unfortunately, the Fed needs to start seeing signs of that before they can stop. That's my view. You might, but like you say, you can go too far. You could go too far. And let's take a depression. Be lovely to see everybody losing their houses at that point, and then somehow they've got to just give free housing to everyone.
Yeah, I wouldn't like to see that at all. I would worry absolutely about what that means for the bunch of things that I own. No one's going to buy an iPad if they haven't got a house, are they? I mean, I think Buffett thinks they would, but I think he thinks people would rather own kind of Apple gear than houses. And I don't know, maybe he's right. But I've reminded myself, the point that Steve was attributing to me before, I've thought that if the Fed does ease off on this without signs of inflation, at least as far as I can see coming down, I would worry incredibly about that, because that just means, to my mind, that the US economy can't take it, and that this is effectively another bailout, and the tightening is going to have to happen all over again, effectively. So I would just see that as a sign of what they're calling a hard landing, and I would be very wary about kind of taking much solace in a relief rally there.
That's a lost decade, that is. That's a full-on lost decade.